Price moves up first, but it cannot stay above. The session forms inside old pressure. April 27th Asia session forms between April 17th U.S. session midpoint and April 17th U.S. session upper boundary. It forms at almost half compression. The box is narrow. The distance is short. Price is not moving from open space. It forms inside April 17th U.S. memory. That matters. When a session forms between midpoint and upper boundary, price already sits near a decision area. It can push above. It can fail fast. It can return inside. So you do not chase the first lift. You wait for the boundary. Price moves up. It reaches April 17th U.S. session upper boundary. It breaks above. The move looks strong, but strength must stay. It must move away. It must create distance. Here, price pushes higher. It reaches April 27th U.S. session lower boundary. It tests the level. Then it slows. The move does not keep distance. The reaction comes faster. Buying loses control. That is where the short starts to form. Not at the first red candle. Not after panic. At the failed hold above April 17th U.S. upper boundary. Price came up. It reached the old upper boundary. It moved through. Then it failed to stay. That failure matters more than the break. April 27th Asia session gives the short setup. Short entry line. April 17th U.S. session upper boundary. Stop loss line. April 27th U.S. session midpoint. Take profit line. April 27th Asia session lower boundary. The entry line sits at April 17th U.S. upper boundary. Why there? Because price tested above it. It could not keep control. It returned back toward that boundary. If price cannot stay above April 17th U.S. upper boundary, the upward attempt has failed. That is where the short forms. The stop sits at April 27th U.S. session midpoint. This stop is not the prettiest number. It is the safer line. There is another option. April 27th U.S. session lower boundary. That stop gives a better risk-reward ratio. It looks cleaner. It looks more efficient. But live trading does not reward clean numbers. It rewards stops that survive. Before this short forms, the earlier April 27th Asia candles already tried to test April 27th U.S. session lower boundary. That area has already been pressured. A stop placed there can get touched again. Price can touch it without true failure. Price can wick into it. Then price can still fall. You are right about direction, but you are gone. So the safer stop moves higher. April 27th U.S. session midpoint. If price reaches that midpoint, the short has lost more control. The return above the lower boundary is not just noise anymore. It is stronger recovery into the U.S. box. That is why the stop goes there. The target sits at April 27th Asia session lower boundary. Price formed inside the Asia box. It broke up and failed. When the failed break returns, the first target is the lower side of its own session memory. You do not need a collapse. You need the failed break to return home. That is enough. Price drops. It moves back inside April 27th Asia session box. It continues lower. It tries to reach April 17th U.S. session lower boundary. But watch the movement. It is not clean forever. The first drop is sharp. Then candles slow. Pullbacks deepen. Distance becomes shorter. That is where you manage. The short is working, but the market is still inside old memory. You do not hold blindly. You watch the next boundary. First trailing target. April 21st U.S. session upper boundary. Price has moved away from entry. The trade has earned distance. Now the target can move lower. But target cannot move alone. The stop must also move. If the stop stays too far behind, you are not trailing. You are just hoping. If the stop moves too tight, the market touches it. Then the original plan may have paid more. That mistake happens often. A trail must protect profit, but it must still give space. Price drops again. It reaches toward older memory. The second trailing target becomes April 21st Asia session lower boundary. Risk-reward ratio, 3.25. That second trail can work only after proof. Price must keep moving away. Price must fail to reclaim the prior boundary. Price must make lower reactions. Then the trail earns the right to extend. But the stop must follow with enough room. If you raise the stop too close, normal reaction takes you out. Then the trail becomes worse than no trail. If you raise the stop with enough room, but it still remains below the entry line, the trail does not protect profit. Then you should not trail. That matters. Trailing should improve the trade. It should not make the trade weaker. If the new stop does not cross beyond entry, or at least protect the earned structure, you stay with the original plan, or you take the profit. You do not pretend management exists when the line still gives risk back to the market. Now look at the whole short again. April 27th Asia session forms compressed between April 17th U.S. midpoint and April 17th U.S. upper boundary. Price breaks above April 17th U.S. upper boundary. It reaches April 27th U.S. lower boundary. It cannot stay. It returns. Short entry comes at April 17th U.S. upper boundary. Stop goes to April 27th U.S. midpoint. Target goes to April 27th Asia lower boundary. Then trailing can extend toward April 21st U.S. upper boundary. Then toward April 21st Asia lower boundary. Risk-reward ratio reaches 3.25 only after the trade earns movement. Nothing starts from prediction. Everything starts from failed holding. The key mistake is stop placement. A stop at April 27th U.S. lower boundary looks better, but that line was already under pressure. The safer stop sits at April 27th U.S. midpoint, because if price reaches there, the short is no longer clean. The move failed above. It dropped. Then it would be returning too deep. That is enough to leave. The market does not care that the tighter stop gives a better ratio. It only cares whether your stop survives the real movement. So the rule stays clear. Do not place a stop where price already tried to test. Do not trail unless the trade has earned distance. Do not move the target without moving the stop. Do not tighten the stop until structure allows it. Price reaches. It fails. It returns. Then you execute. Price turns up again. But the long needs room. The session forms inside lower memory. April 28th U.S. session forms between April 17th U.S. session midpoint and April 17th U.S. session lower boundary. It forms at almost half compression. It overlaps lower structure. April 27th Asia session box and April 28th U.S. session box together almost match the inside of April 17th U.S. session box. That overlap matters. The market is not free. The market is building inside April 17th memory. When two newer boxes combine and almost fill an older U.S. box, price can move sharply from one side to the other, but it can also return fast. So the trade needs structure. It cannot be chase. April 28th U.S. session first forms lower. Price holds near the lower side. It does not collapse. It starts to lift. Now the long setup appears. Long entry line. April 28th U.S. session lower boundary. Stop loss line. April 21st U.S. session box. 150% lower extension. Take profit line. April 27th Asia session midpoint. First trailing target. April 17th U.S. session upper boundary. Second trailing target. April 27th U.S. session lower boundary. Risk-reward ratio. 3.18. The long begins at April 28th U.S. session lower boundary. Why there? Because price forms near the lower side of the compressed structure. It does not break down cleanly. It starts to move away. If price holds the lower boundary, the long can start. If price loses that boundary, the long has no reason. The entry line is not the middle. It is the lower boundary. In compressed structure, midpoint entries can be dangerous. The box is too narrow. Price can cross midpoint repeatedly without choosing direction. That is why the lower boundary matters. Price must show it can hold the edge. Then the long has space. The first target is April 27th Asia session midpoint. That target is not random. April 27th Asia session created the prior short pressure. Its midpoint becomes the first memory above. If price rises from April 28th U.S. lower boundary, the first serious test is the April 27th Asia midpoint. You take that seriously. If price reaches it and stalls, the long has paid its first job. If it holds above it, the trail can begin. Now the stop decision matters. There are two stop options. First option, April 21st U.S. session box, lower boundary. Second option, April 21st U.S. session box, 150% lower extension. The first option gives a better risk-reward ratio. It is closer. It looks attractive. But the chart already gave the warning. During April 28th U.S. session candles, price already touched April 21st U.S. session lower boundary. That matters. A level already touched can be touched again. A retest does not always mean the long is wrong. It can be noise. It can be wick pressure. It can be a normal check of lower memory. If your stop sits there, the trade may end before the structure fails. So the safer stop sits deeper. April 21st U.S. session box, 150% lower extension. That gives the trade room. It reduces the chance of getting stopped by the same tested level. The ratio becomes less pretty, but the trade has better survival. Again, the method does not chase the best-looking number. It protects the position where the idea actually fails. If price reaches April 21st U.S. 150% lower extension, the lower memory is no longer holding. The long is wrong. That is the stop. Now price moves upward. It reaches April 27th Asia midpoint. It reacts. It does not need to be perfect. It needs to stay. If price holds and moves away, the first trailing stage can begin. First trailing target. April 17th U.S. session upper boundary. Price has moved from lower memory toward the older April 17th range. The target can expand. But the stop must move too. You cannot raise the target and leave the stop behind. That is not management. That is greed. The stop must follow the structure, but it cannot be too tight. If it sits too close to current price, the market touches it. Then you earn less than the original plan. A good trail gives price room while protecting the earned move. Price continues. It reaches toward April 17th U.S. upper boundary. That area matters. April 28th U.S. session formed inside April 17th lower memory. If price reaches April 17th upper boundary, the move has traveled through the old box. That is a major return. Now the second trailing target can appear. Second trailing target. April 27th U.S. session lower boundary. Risk-reward ratio. 3.18. The target moves there only after proof. Price must move away from entry. Price must hold above April 27th Asia midpoint. Price must not collapse back below the lower memory. Then the trade earns extension. If price does not earn that distance, you do not use the second trail. No proof. No trail. No movement away. No larger target. Now, the important warning. April 21st U.S. session box and April 27th U.S. session box have narrow ranges. Their midpoints are not good lines for entry, stop, or target. Why? Because narrow boxes make midpoint too thin. Price can cross the midpoint without changing structure. A midpoint inside a narrow box can act like noise. If you use it as a stop, you may get removed too early. If you use it as entry, you may enter inside chop. If you use it as target, you may exit before the structure completes. So for April 21st U.S. and April 27th U.S. session boxes, avoid using midpoint as the main execution line. Use upper boundary. Use lower boundary. Use extension. Use a line that shows real failure. The trade depends on survival. Now connect the long. April 28th U.S. session forms compressed inside April 17th U.S. lower structure. April 27th Asia and April 28th U.S. together fill the old April 17th box. Price holds the lower boundary. Long entry starts there. Stop goes below. April 21st U.S. 150% lower extension. Target begins at April 27th Asia midpoint. Trail can extend to April 17th U.S. upper boundary, then to April 27th U.S. lower boundary. Risk-reward ratio reaches 3.18 after the trade earns movement. The core problem is not direction. The core problem is stop survival. A tighter stop at April 21st U.S. lower boundary looks better, but that level was already touched. The safer stop goes deeper. A midpoint inside narrow boxes looks usable, but it does not carry enough weight. Use stronger boundaries. Use extensions. Use newer and wider memory. Now, look at the full structure. Part 1 gave the short. Price failed above April 17th U.S. upper boundary. It returned into April 27th Asia memory. Part 2 gives the long. Price holds April 28th U.S. lower boundary. It moves back toward older upper memory. Same market. Opposite trades. Not because opinion changed, because behavior changed. Short forms when price cannot stay above. Long forms when price cannot stay below. Stops change because volatility changes. Targets change because memory changes. Trailing changes only after the trade earns distance. That is the entire method. Price reaches. It reacts. It either holds or fails. Then you act. If price fails above the boundary, you short. If price holds below the boundary, you wait. If price holds lower memory, you long. If price touches a stop line already tested, you think again. If the safer stop reduces the ratio, you accept it. Because survival comes first. The chart will always offer a prettier number, but the market pays the structure that survives.